Okay, just looking at the financial results for the year ended 31 August. Some highlights. On a full year basis, we've achieved a distribution of 64 cents per unit, and that is in line with our market guidance. This time last year we gave exactly that amount, and we're pleased to have achieved exactly what we said we would a year later. Our total tangible assets are 42 billion rand, and we have a net asset value of just over 8 rand. Last year it was about 7.85 rand, and I'll talk a bit more about that in a short while. Our market capitalization at 31 August was 26.5 billion rand, and as Mark said earlier, we've broadened our funding sources to the debt capital market, which at the moment is very attractive from a funding cost point of view, and we will also talk a bit more about that in a short while. Our average cost of funding has been reduced by about 70 basis points to an average cost of 8.9%, and that's on the back of participation in the debt capital markets and also having renegotiated some expensive debt which was negotiated at a very different time in the life of Redefine. Our core operation has been solid. We'll unpack that some more, but you'll see that we've grown the core business by 8.3% in revenue terms, and that is a margin of 76.3%, which once again we'll explain how we achieved. And then I think lastly, which is very pleasing to see, is that we've been able to reduce our trading and fee income as a percentage of total revenue to, from a local point of view, to about 3%, which in our view is a wonderful achievement, because in the past we've always had a problem with non-recurring income, and we've moved our focus away from that in these numbers. Okay, just moving on to the distribution and explaining the 64 cents. If you look at the 64 cents, it will compare negatively to last year's total distribution of 68 cents. And in percentage terms, that's just under a 6% decline. However, one needs to take into account a couple of facts. One being the non-recurring income in 2011, 4.6 cents, most of which was for the Hyprop transaction fee. And then along with that was the Arrowhead unbundling that contributed 4 cents to the 2011 numbers. If one excludes those two elements, along with dilution arising from additional units that were issued during the course of 2012, you get to a recurring base of 58.5 cents. And you will see that that grows by 7.2% in this financial year to 62.7 cents. And yes, we do have some non-recurring income this year of 1.3 cents, taking us to the 64 cents. Looking just in terms of the spread of the distributions per linked unit, you'll see that in the first half, we only grew by 2%. The reason for that mainly was because of Arrowhead having been unbundled in the first half. And in the second half, you'll see quite a big decline of about 12%. Once again, Arrowhead is a factor. Along with that would be the Hyprop transaction fee that was earned in the second half of last year. Once again, backing them out, you'll see that there would be positive growth. Looking then just at how the contribution for the 2012 year has come about, you'll see that the bulk of our earnings come from the local property portfolio. This is in cents per linked unit terms, 71 cents. We do have listed income of 14 cents, small trading income of 2.3. That's reduced by admin costs of 4.3 cents. And then you'll see interest costs, and this is for the local operation, of 25 cents. Now that 25 cents in relation to the revenue that is generated is approximately 26%, which we believe is quite a pleasing ratio. The local contribution totals 57.7 cents. In percentage terms of the total distribution, that's 90%. And you'll see that the international operation has generated 6.3 cents for the 2012 year. Moving on then just to the detail of the distributable income. I'm not going to dwell too much on the top line, where the bulk of our revenue comes from, because we deal with that in detail later. But that's grown in total terms by just under 1%. Listed securities 4%. The reason for why it's only 4 is because in 2011 we recognized some pre-acquisition income from Hyprop, which was a once-off benefit. Fee income has reduced quite significantly from 2011. The reason for that is because of the Hyprop transaction fee. And then property trading income similarly has reduced, And the reason for that is that because we've exited out of a number of speculative trading joint ventures that we had in Cape Town that we sold to Arrow Creek. And then also there have been sales at Buchanan, which is also in Cape Town, that have been quite subdued in this financial year. Admin costs, as you can see, have grown quite substantially. Most of that increase has arisen from two elements, one being the marketing focus that we've embarked upon that Mark spoke of earlier, and also our phantom share option scheme had to be lifted given the share price appreciation over the past couple of months. Share of distributable income of associates, as you can see, has jumped up quite nicely. The reason for that is the Cromwell income that we receive directly, we've put in as an associate because we account for it on that basis from a group point of view, given our 27% holding through Redefine International combined with ours. Finance costs, as you can see, have only increased by 4.4%, even though our funding levels have increased. And that comes back to the 70 basis points average reduction in finance costs. The international distribution, as you can see, has increased by 29%. A big part of that has been the conversion of foreign income into rand. There has been some rand weakness of late given the market volatility that has arisen from labour unrest and so forth. But there has been underlying growth in the international business, which Mike Waters will talk about, arising from the Witchford transaction. Looking then just at the core properties, you'll see if I just move from the bottom upwards, because that number I would have spoken of earlier, if we split out the investment properties performance between core and then exclude items that are not in for a full period in 2011 or 12, arising from acquired or disposed properties, you'll see that the property income from the core portfolio, that's properties that we've owned for 12 months in both periods, has grown by 8.3%. The revenue, which I'll unpack as well in a short while, has grown by 6.6%. But I think what is more pleasing is to see a 1.7% cost increase, giving rise to that 8.3% improvement in the income from the core business. Once again, the margin, as you can see, grows from 75.2% to 76.3%. And once again, I'll show to you how that comes about. In terms of the revenue performance, this is revenue. I think David will speak more about square meterage, which is his currency. But obviously, the two go hand in hand. So in a very competitive market, the revenue and the square meterage kind of don't talk to one another. But having a look at it from a revenue point of view, what stands out is that on a total basis, vacancies have given rise to a decline in revenue of 74 million rand. However, and it's coincidental, it's not by design, but new lets have replaced that lost income. So in revenue terms, we've stood still. From a vacancy point of view, we've been able to replace the revenue we've lost. And you can see from renewals, we have been able to eke out some income there, 23 million rand, which has given rise to a 1% growth. And the bulk of the growth obviously coming from contractual lease escalations, which run with our leases. Once again, looking at it on a per sector basis, offices are in a difficult position with their vacancies exceeding their new lets in revenue terms. Retail has held out, and we've done very well on the industrial front. And this is the benefit of having a diversified portfolio where you are able to mix and match. Year-on-year growth, as you can see, despite this challenging environment, is all in excess of 6.5% on the sectors, giving rise to the 6.6 overall percentage growth. Moving then on to the core property expenditure analysis, you will see here that we've done very well this year on the pressure points, being municipal charges, net of recoveries, and similarly electricity charges, net of recoveries. In both cases, we've managed to either hold them flat or slightly reduce them, and that will be an ongoing focus, because as landlords, that is one area of the business where we do have significant pressure going forward on an ongoing basis. Bad debts, as you can see, has crept up. That's a function of the economy, and hopefully next year that will improve. I'll talk a bit more about bad debts in a short while, and I think the other item just to highlight here is repairs and maintenance. We've had a year where we've had to dip into our pockets a bit more than we would have expected. However, this is good spend in that you spend it now, you avoid it later. There's always a temptation to defer repairs and maintenance, but it will always come back and bite you when you least expect it to. And 2012 was the year where we decided we'd rather spend than rue the decision later on. And then just coming back to the ratios, you'll see that they're all healthy. We went back to 2010 just to make sure that it wasn't a once-off benefit. And you can see that property management is making a big difference here to overall costs. Property management costs, although in revenue terms it doesn't look like it's made a big difference here to the base, you'll see in the next slide that it does have a significant impact. What I've done here is I've taken for every 100 Rand of property revenue, you can use it as a percentage rather than Rand if you like, and you can see how the property costs actually impact on our margin of 76.3%. Going back to 2010, you'll see that net municipal charges and electricity charges were about 4.2% of revenue. Currently, it's sitting at about 5.1%. However, if you look at last year, it was significantly more than that percentage. So there we've made a difference this year, giving rise to some of the margin improvement year on year. I think property management, if you look, has declined from 4.5 down to 4. And then bad debts, I just want to mention, has basically doubled since 2010. I think it's going to come back a bit in the new year. But once again, for a business of this size, to have bad debts under 1%, I don't think is a big issue at all. And then coming back to management fees, you'll see a huge reduction there of 4.4% in 2010, moving down to 0.7%. And that's where the benefit of internalizing property management has come in on that line. And yes, it has been offset to some extent by the net municipal charges and electricity charges. However, we've still got a significant benefit overall. Looking at the balance sheet, just some areas that I'd like to just point out on 2012 versus 2011 first. Investment properties, David will talk a lot about, so I'm not going to dwell on that growth there of 1 odd billion Rand. Listed securities, we've had a fantastic run on the Hyprop share price, which has resulted in most of that growth from 4.7 billion Rand to 5.3. Intangibles have grown. That's as a result of the acquisition of the Fountainhead Management Company. Interest in associates, that's been the Cromwell investment. As a group, we participated in December last year in a capital raise, giving rise to an increased investment in Cromwell, but there's also been good capital appreciation in that investment. Moving down, you'll see debt. We'll talk a lot about in a short while, so I won't dwell on that one, but you'll see that there is reductions in the debt year on year, but a lot of it has moved down to that non-current liabilities held for sale line, where significant restructuring has happened in the international business, which in the new year will all be taken out of this balance sheet, hence the reason for disclosing both non-current assets held for sale and liabilities held for sale, because the two are linked. Mark spoke earlier about decreasing our investment in Redefine International. That reduction to 49.3% has resulted in us to be able to deconsolidate our balance sheet. So what I've done on the far right-hand column, I've provided you with a 2012 balance sheet on a deconsolidated basis. And what I'm highlighting with those red blocks there on certain numbers is on the assets that effectively are taken off balance sheet, but similarly there is non-recourse international debt that also disappears with those assets. And as you can see, the two almost offset each other. The net result is that our net asset value on this basis improves by about 22 cents, which is on the next slide. You'll see that our net asset value as a group for 2012 has increased. The main reasons for that is because of the local appreciation in value of our investment properties as well as listed securities. And we also had a capital raise of about 650 million rand during the course of the year. International, however, you'll see an 18 cents decline. That has arisen from mainly restructuring of debt. I think the Gamma facilities are sitting in that number. And then there are also shopping centres in the UK that are also feeling the brunt of a very fragile economy in the UK, which is also driving to some extent that number. But most of it would be as a result of debt facilities in the process of being restructured over there. The Arrowhead unbundling is also impacted to the extent of 30 cents on NAV. And as I said earlier, the value of, or the net asset value of the deconsolidated group at 822 cents is essentially what we will be using for the Fountainhead transaction as currency, and that's an important number for us going forward. Looking at our listed securities, the bulk of our listed securities are in Hyprop, as you can see, 5.3 billion rand, and there has been some movement here. What this slide will show you is the intent of Redefine to be exiting out of its listed security portfolio. We've already sold 2 million Hyprop units, resulting in that decline from 31% to 30.4%. And then Oryx, we sold in the last week of September for 184 million rand, and that line has been taken to the non-current assets held for sale, pending their disposal. That transaction, by the way, took 7 months to consummate. It's an illiquid stock, and it was sold to a consortium of local investors. The Fountainhead Property Trust, as you can see, we got a very small holding there as a result of acquiring the Manco. Cromwell, as we said, has grown, and that has been through the participation of Redefine investing directly, as well as Redefine International participating with Redefine in a capital raise in December. In terms of funding, local debt is just over 9 billion rand, and that is what we manage here on a daily basis. You'll see that the bulk of it is from bank borrowings, and over time we'll be looking to up that to 30% of the total. So any new debt that we require, we intend going to the debt capital markets for, and possibly any facilities that come up for renewal that we can't repay through the sale of assets such as Hyprop and so forth will also come from the debt capital markets. Non-recourse international debt sits at 11.5 billion rand, and these are gross numbers because some of that debt, about 1.2 billion thereof, is sitting in non-current liabilities held for sale. But the total borrowings on balance sheet is just under 21 billion rand, and you can see it's about 3 billion rand more than last year. In terms of local loan-to-value ratios, we're very comfortable at 32%, with our target at 35%. As I said earlier, our weighted average cost of borrowing sitting at 8.9% versus 9.6% last year. And then the level of fixed debt, currently at 68%. Our target is 65%. And we have a projected funding headroom of just under 500 million rand. Moody's refreshed their credit rating on the 12th of October, and we're happy to say that it has remained unchanged. And for us, that's good news, given that most other institutions out there have been suffering from downgrades of late. Looking then just at the cash flow, I think the important takeouts here, if we just focus on the local line for 2012, is the productive use of cash. Whatever spare cash we have, we reapply to debt. We've got drawdown facilities whereby we can place debt with the funding providers, and you'll see that we've raised 2.2 billion to invest 2.3. So all we're trying to do is minimize our cash on balance sheet through keeping as much of the free cash that we have applied to debt and drawing as and when we require it, and that is a delicate balancing act, as you can see. Just looking at the generated by operations, we're quite happy with our ability as a group and as Redefine locally to be able to more than sufficiently cover our interest paid to institutions as well as to our linked unit holders from operational cash flows. Okay, just looking at the unit holder profile, there's been quite a bit of movement in the top 5 here. Standard have consistently been at the top, but the balance have moved around, and as you can see, the government employee pension fund is now moved into the second slot at 5.4%, Old Mutual at 4.8%, and so it carries on. There is one international investor, State Street, at 4.4%, being our number 4 investor at this point, and they've come from nowhere onto that position. I think another welcome addition to this top 10 list here has been the Eskom Pension and Provident Fund, who also have appeared from nowhere, having sold their stake in Pareto to the PIC and having cash to invest. So the top 10 unit holders comprise 40% of our total our total unit holders out there. Looking then just by country, the international investment interest in South Africa sits just under 15% at the moment. But what is of interest is looking at the bottom left-hand side. In 2008, we had just over 1% foreign ownership. That's grown over the years to 15%, with most of the growth coming in the last year or two. Redefined share price, as you can see, has ticked up quite nicely. If one has to update it for the last few weeks, we could well see that line going the wrong way. But I think what is of interest would be the volumes traded. As you can see, Redefine has had significant volumes over the past while, and a lot of it has been driven following the Fountainette Manco acquisition. Just looking at total returns, Mark did speak earlier about a 30% return to the unit holders, and I thought I'd just provide some academic backup to his statement. And as you can see, I've done an analysis here, removing the Arrowhead unbundling out of the numbers, just to give context to how Redefine has added value to its unit holders had they have held the unbundled units for the 2012 financial year. We've adjusted the opening price for the unbundled NAV, which was the listing price of Arrowhead, of 30 cents on a combined basis for the Redefine unit holder. And then what we've included in there has been the 2012 distributions declared by Arrowhead as well as Redefine's. As you can see, Redefine is just over 29%. Arrowhead has shot out the lights at just under 38%. And on an overall basis, we arrive at 29.9%. With that, I'm going to hand over to David.